I think crypto investors are probably in the same boat right now. Like they're trying to trade every tick. Every time the market goes down or 20%, they think we're about to implode and the market's going to, it's like, it's not going to happen. We're probably going to go up for 10 or 20 years. And 2022 was an anomaly, not the norm, and something that firms and individuals will learn from and most likely not repeat anytime soon.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Jeff, thank you so much for joining me today. Super excited to chat with you. All right, Jeff, you are a partner and chief investment officer at Arca Asset Management. You guys manage over $1 billion AUM, and you're exclusively focused on the digital asset sector. You have very extensive background in TradFi. You were at Lehman, you're at Merrill, you're Citadel Securities as well. So Jeff, take me back to, so actually I was going through your LinkedIn and I think you were at Merrill in 2008. So can we talk about that? Because that must have been a crazy period.
Yeah, that was, I think my first 8 years in New York coincided with 9/11, Lehman, and Merrill. So I saw a lot in my first 8 years of my career.
That's crazy.
Yeah, Merrill. I mean, Merrill was it's funny, you know, one of the interesting things about being in crypto now full time is obviously most people are younger than me. And you mentioned the name Lehman Brothers, for example, and people just assume that's the worst company in the world. And, you know, because of all the stories that, you know, Lehman was an awesome place when I came out of college. I mean, it was prestigious. I had multiple offers at different investment banks, from Goldman to JP Morgan to Citi and Lehman. And I chose Lehman because that was the place, that was the culture. And obviously that has been incredibly tarnished. And even Merrill Lynch, right? I mean, Merrill, having been bought by Bank of America, still sort of has the brand, but I think a lot of people, don't recognize how fun it was working on Wall Street in the early and mid 2010s.
Also, we should note that I believe you were the top investment banking analyst at Lehman for like 2 years in a row, I believe, right?
Yeah. And I mean, as funny as that sounds, there was actually a ranking system. There was something like 200 or a little over 200 analysts in my class. That's how it worked with analysts and associate classes coming out of college or grad school. And they would actually rank you. And I was ranked number 1 2 years in a row as an analyst. Not necessarily because I was amazing at finance, but mostly because I was really good at using Excel. And a big part of investment banking was just being able to navigate spreadsheets and PowerPoints and understanding how to navigate the system there. If you read a book like Monkey Business, which is now probably completely outdated, but that's a great book kind of about just the ludicrousness of investment banking and what it's like working there. And it's pretty accurate. I mean, it was a really fun and interesting way to start your career. And then again, like you said, Merrill Lynch in 2008. I mean, up until 2008, working at Merrill was amazing. Probably the funniest. Even 6 months before the financial crisis. I mean, I remember we had our Merrill high yield leverage finance conference out in Vegas. It was like 1,000 of our clients and people at Merrill. You know, they were starting to see a little cracks in the system by then, but nothing crazy. And it was probably the most telling thing about working at Merrill leading up to the financial crisis was, I worked on the high yield distressed, leverage finance desk, and we were front and center on the 3rd floor of 3 or 4 World Financial. I think it was 4 World Financial. It's a big, huge trading floor. The 2nd floor, I think, was equities. 3rd floor was fixed income. Leverage finance was this big part of it. And over the course of the 3+ years I was at Merrill, we just kept getting pushed further and further into the corner of that floor, and it was getting replaced by the CDO guys and all the mortgage-backed guys, and basically everything that led to the financial crisis. You could see it in real time if you just had an overview of our floor plan of just how much that desk changed in 3 years, from typical bread and butter bond trading to a bunch of PhDs and quants coming in with models on ABS and MBS and CDO squared that ultimately took down, not just the company, but quite a bit of the financial industry as well. But it was wild. I mean, I'm 45 years old now. I mean, this is a long time ago, but you learn so much, working in investment banking and trading and research at some of these big financial hubs. And I do think a lot of the people in crypto, while I wouldn't suggest that there's any reason necessarily to go back into TradFi and work at these places, But I think the attitude that if you have a CFA next to your name or that you worked on Wall Street, that you're some sort of, either criminal or misinformed person, like it couldn't be further from the truth. I mean, you learn so much working 100-hour weeks at these places.
So was there any inklings of, hey guys, like something's going on at Merrill in '08? Was there rumblings that, hey, like things look unsteady, or was it pretty sudden?
No matter where you are, there's always some hints of risk and some hints of excess that you see. And the question is always just how big is it and how widespread is it? I mean, if you go back to what ultimately happened in September of 2008 with the fall of Lehman Brothers, and then eventually, basically the next 7 months from September of '08 till March of '09, when one by one, all these building blocks kind of fell. It really kind of started in March of '07. There was a prop desk hedge fund, I guess it was a hedge fund owned by Bear Stearns, that started to have real problems. And that was a big wake up call. Everyone was like, oh, something's not right here. Like, these guys were certainly over levered, certainly had major issues with marking of their books with all this MBS and ABS. And that kind of got swept under the rug almost for a year. I mean, if you actually look at a chart of equities or credit, I mean, you see that little blip in March of '07, it kind of went away, and then markets basically went straight up again until March of '08 when Bear Stearns actually went under. And even then, if you go back and look at it, like, things were actually kind of calm again from like May of '08 until about July of '08, until ultimately, everything picked up again. But I mean, again, in retrospect, there was a lot of signs of the issues that we were seeing. I mean, you saw, first thing, like always, you see the funds that were more levered than others having problems. You started seeing, massive unwinds of things that were, quote unquote, risk-free from an investment standpoint, but not risk-free from a funding standpoint. Things like, for example, if you were long bonds and long CDS against it, right? Your risk report would basically show that you were flat risk, right? If you had 10 million long of bonds and 10 million of CDS against it, that would net out as, a zero net position. But that's a huge balance sheet position. And when you start to see funding collapse and you start to see, cracks in the system, that's the first stuff to go. So we certainly, I'd say 6 months before the real kind of crisis began in the summer of '08, we started to see a lot of those guys unwinding, massive selling of, like I said, positions that would be deemed neutral from a risk standpoint, but certainly not neutral from a balance sheet and a leverage standpoint. And then you saw little things, again, this was for those who have never been on a massive trading floor, I mean, these are huge, huge buildings with huge open floor plan, seating where, you can walk around for 15 minutes and not see everybody on the floor. All of a sudden, in the summer of '08, you started to have a little bit more people walking around that you'd never seen before. You saw some risk officers, some accounting people. There was definitely a sense of something wasn't right, and we weren't being told everything that was happening. You can, when the CEO is walking around the credit floor, that's not something you see every day. So there was signs. There were certainly, things, and a lot of people set their portfolio up that way. I remember I actually had one, I was I guess I was 28 years old at the time. I was running one of the high yield trading books at Merrill. So I was trading gaming, leisure, lodging, paper packaging, certain sectors. I had a massive short book through CDS, owning a lot of credit default swap contracts in addition to owning a lot of, long bonds. And people, again, people I'd never seen before, summer of '08, were starting to tell me to lighten up the balance sheet, don't commit capital to certain trades, things like that. What was interesting, though, is, even some of the people who saw some of this coming and started positioning from the short side, there were some senior traders walking around, I remember, who said, don't even bother, because if you're short and you're right, you're getting fired anyway, because the only reason you're going to be right is because of some massive meltdown. Whereas if you're long and you're right, at least you'll get paid. And, obviously that's not it's not actually a constructive comment. If you're a shareholder of a Merrill Lynch or another investment bank, but that was sort of the going attitude at the time, was like, just be long, because the firm has to have a good year for you to get paid anyway. So why try to profit on the short side? So there was definitely some excess risk taking across the firm that was caused by sort of the general attitude. of just sort of be long all the time.
Man, I want to ask you questions about like, have you seen any, did you experience, that was a momentous event. That was pretty insane. And going into crypto and being in crypto for so long, have you experienced anything similar to that? Like, I don't know, FTX, Luna, et cetera, something of that magnitude? Like, were you like, oh, this is kind of like one of those situations. This is an '08.
Yeah, and this is where, I mean, obviously the price action in crypto is much more volatile, and you have much more frequent, huge moves higher and huge drawdowns than you do in the equity and debt world. But this is, again, where I think having some actual experience in other markets really helps. Like '08 was the equivalent of 2022 in crypto, right? 2022, like, I hear people now being like, it's over, it's just like 2022. It's like, no, it's not. Like, that's ridiculous. In 2022, your counterparties were failing, right? You were afraid to put money on an exchange because the exchanges were failing. You were afraid to put money in smart contracts because protocols were failing. You were afraid to put a short on because you couldn't actually borrow from a counterparty because your counterparty, your lend borrow client was failing. The safest thing to do in 2022 was to just own an asset in your own wallet and do nothing than actually trying to trade or transact, because it was much more uncertain about who you had risk on with than it was what your actual risk was. And even if you had an 80 or 90% drawdown, again, it was safer from a peace of mind, from a risk management standpoint, to own an asset that went down 90% than it was to own risk with a counterparty that was failing. And that was the same thing in 2008. Like, you could have had the best portfolio in the world in 2008, but if you had credit default swaps that were facing Bear Stearns as a counterparty, or Lehman as a counterparty, or Merrill as a counterparty, or MF Global as a counterparty, it didn't matter what your position was. It mattered who you had risk with. Most of '08 and '09 was trying to figure out the pieces of who had risk with who, where the holes were. Did you have something that had a paper profit, but really that was gone because the counterparty that owed you the money was about to go, evaporate? That is an incredibly different environment than, oh, the stock market's down 15 or 20% because of a tariff or a temper tantrum, or because, crypto's down 40 or 50% because, a bunch of, paper-handed traders are selling everything. Like, prices don't necessarily reflect the environment. And I think there's a lot of PTSD in crypto that, again, because most of the people in this industry just don't have a lot of experience in investing or trading. As soon as you see prices decline, you just immediately go back to 2022, and it's just not the same. I mean, DeFi works really well right now. The protocols work really well right now. The counterparties have the biggest balance sheets they've ever had. Nobody's lending in the same way that they were before. It is just a different environment. And, again, going back to '08, I had 8 years of experience by the time '08 happened, and I lost half my net worth because of the crash in the market. I lost my job when Merrill imploded. It probably took me 3 years, I would say, before I was actually, and again, I had a CFA. I was pretty, smart with finance. I understood how it worked. I understood that at 28 years old, you want to be fully invested at all times because markets grow over time and there's no reason to hold cash. I would say it took me 3 years before I was fully invested in the equity market again. In fact, for most of 2009 and 2010, I was still like shorting and trying to think I could time the market and figure out, like, I was like, oh, this recovery is not real. The government's propping it up. It's all going to collapse again. Like, it does take time to recognize that markets generally go up over time and that you want to be invested. And I get that. But you go back to 2011, 2012, people were expecting the entire European Union to fail. I mean, hedge funds were sending teams of people to London to try to buy European bank debt at 10 and 20 cents on the dollar because they expected every bank to implode, and they didn't. They ended up being fine. A lot of it was because of government bailouts. But again, this was 3-4 years after '08, and people still thought that the world was going to collapse. And of course, now we know in retrospect that didn't happen, and instead it was a 17-year bull run. From '09 to today, and still going. So I think crypto investors are probably in the same boat right now. Like, they're trying to trade every tick. Every time the market goes down or 20%, they think we're about to implode and the market's it's not going to happen. We're probably going to go up for 10 or 20 years. And 2022 was an anomaly, not the norm, and something that firms and individuals will learn from and most likely not repeat anytime soon.
All right, so I want to go a little bit back. How did you first get involved with crypto? Because you had a very extensive background in TradFi. You could have continued to TradFi, but what made you be like, oh, this is an area that I actually want to jump into and go, fully commit to?
Yeah, so as I mentioned, like, I went from investment banking to credit trading to high yield distressed to, portfolio management on the buy side. And my whole career was value investing, understanding balance sheets and income statements, what drives investments. And by the time kind of 2014 rolled around, we were now 5 years removed from the financial crisis. And it got really boring trading bonds and stocks because everything was just sort of going higher. There was no real rhyme or reason for it. It was just sort of, I think high yield and distressed was trading at like 5 or 6% yields. I mean, something crazy that just wasn't that interesting anymore. So I took a break from Wall Street and went to go help a friend build a fintech company, which I thought would be like, a year or two at best, and I'd be back on Wall Street, or, it would either be boom or bust, right? We'd either kill it and be billionaires, or we, would be out of business. And I ended up actually working there for like 7 years. But during that time, it was the first time I was working directly with full stack developers. We had anywhere from 8 to 12 developers at any given time. And all they would talk about was open source protocols and how coding language was changing because of, open source. And they started mining for Bitcoin and Litecoin and Ethereum back in, 2015, 16, 17. And at first I understood Bitcoin immediately from a macro lens. It just made sense from, having been in finance for, almost 15 years at that point, and understood, why people care about gold and purchasing power of the dollar and things like that. So it's like, okay, but Bitcoin made sense as a macro trade. I kind of got that and invested in very small size back in 2016. But then when I started to realize why these developers cared about it, and it had nothing to do with the macro, it had nothing to do with finance, it was purely this idea of, decentralized kind of open source protocols, that's when I started thinking maybe there was something more here. And I just sort of, during that time, in 2017, I had moved from New York to LA, and moving, New York is, every single person you meet in New York is doing the exact same thing, right? They're in finance, or they're a lawyer in finance. You meet the same people at the same bars constantly. Everybody is just trying to figure out how they can leverage you for something. You move to LA and it's totally different. Nobody has a real job. Everybody has 10 projects going on. And everybody that I started meeting out here was involved in crypto in some way, and all from a completely different lens. They were all, some of them were, venture investors thinking about, the total addressable market of protocols. Some of them were finance people who were thinking about it from a trading lens. Some of them were, developers and technology people who were just interested in the communication and social and protocol aspect. And it was during that time that, I was still buying small sizes of Bitcoin like every month, but I didn't really know the rest of the world existed until I met my co-founder and partner at Arca, Rain Steinberg, who happened to be the co-founder of WisdomTree, the big ETF company. And he was the first person I met that kind of shared a similar background to me, kind of came up in New York, came up from Wall Street, and he was interested in crypto again for a totally different reason. He had left, he had remembered the '08 crisis when WisdomTree stock was down like 90%, even though they had no exposure to any of the problems, right? This was a growing ETF company that had no leverage on the balance sheet, no exposure or counterparties, and yet they were getting taken to the woodshed too, just because the entire financial system was breaking. And so he started learning about crypto for that reason. Like, how do you protect a company? How do you protect against, these counterparty failures? So anyway, he and I started talking, and we, along with our other partner, Phil Liu, who's a lawyer in finance, but we started thinking about where is the white space in this new industry? Like, where does something like this go in the next 10 years, and where is there no eyeballs focused on it? And what we realized was there were a lot of, technology people in crypto at the time, back in 2017, again, kind of thinking about big picture. And there was a lot of like traders, kind of like algorithmic traders and quant traders who were, interested in the volatility and the correlations. But there weren't a lot of people in the sort of fundamental investing space, like actually digging into the companies and the projects and doing real research on this and understanding, where value accrues to in the tokens or in the equity and across the capital structure. So, we're like, oh, well, this is a perfect place for someone like us, because most people in crypto again, we're kind of technology people trying to learn how to be asset managers. And we said, well, why can't we go the other way? Why can't we be people who know how to do asset management and learn how to trade crypto? And we started Arca in 2018, and 7 years later, probably have one of the longest running track records in liquid crypto investing, just because mostly survivorship bias, because so many have gone away. But it was just, to me, it was just the most obvious way to get involved in the space, was actually understanding the uniqueness about token structure and the capital markets, and what this industry is really doing in terms of capital formation, customer bootstrapping, incentives, and things like that. I mean, I could go on for hours on my thoughts on why crypto is such a fascinating asset class, but ultimately that's how we got to do it, right? I mean, it started very kind of benign and ultimately led to something that I think is likely to be one of the biggest shifts in finance and technology over the next couple of decades.
Take me back to the early days of Arca. When you guys were first launching in 2018, what was that like? Because, that was exceptionally early, and, you're partnered with, you said Ray, and I think Philip, I think you said, and you guys are TradFi guys, which was a very differentiated take. You're absolutely correct. It was a lot of technologists, a lot of crypto natives that were launching stuff. So yeah, take me back to those early days. Like, what was it like?
So the early days were, a couple of people, in a makeshift Regis office trying to figure out what we were building. I think the interesting thing was, again, none of us really knew a lot about crypto at the time and about the actual assets, which didn't bother me at all, because, again, over my career investing and trading, I had invested in every asset class, every region of the world, every, sector. I didn't have to be a doctor to learn how to trade healthcare bonds. I didn't have to be an auto mechanic to learn how to trade, auto stocks. Like, these things are learned traits. It wasn't like we had to know it right away, but we spent the bulk of the first year just researching constantly, talking to founders, trying to understand why is this protocol different? Why is this different? And also spent an enormous amount of time on the legal compliance, like operations side, trying to figure out, like, well, if we're going to do this, how do you do it the right way, right? Like, even if we only start with a tiny asset base, you still have to get that stuff right? You have to envision in your head that you are going to be building something bigger and sustainable, and you have to build things the right way. Like, there's a saying, developers have a saying called technical debt, meaning, like, if you build something with code that isn't perfect, and you come back to fix it later, well, by the time the code base gets bigger and bigger, it just becomes harder and harder to fix some of that stuff without breaking things. Like, we didn't want to create this technical debt. We didn't want to go fast and build something that we knew we'd have to rip up and fix later. So we spent a lot of time, again, on the regulatory, on the legal, and on the ops side, really understanding, like, how do you custody this stuff correctly? How do you, find appropriate fund administrators and auditors? How do you think about the actual transaction risk, and how do you safeguard the assets, and think about, 3 of 5 or 5 of 7 type mechanisms to, ensure that if 3 people get hit by a bus or flying to a conference and something happens, that the assets are still safe. So that was really the early days. Was like, there was a couple of us focused entirely on research and understanding the universe. There was a couple of us focused entirely on ops and building out, the kind of the bread and butter of actually being able to invest and move assets in the space, and a couple kind of working on the legal, docs, regulatory, fundraising, things like that. And ultimately, it was like that really for the first 2.5 years. It was really only until 2020, when the boom of stable coins and DeFi, when our vision started to really play out, that this was more than just Bitcoin, that this was more than just money, that there really were, and that you would be able to look at a token and come up with a real fundamental value for it, and be able to model out cash flows and tokenomics. And for me, having always been a fixed income guy in my career, most people were looking at the space like the currency market or the commodity market or the equity market. I always, and to this day, still believe this industry is way more similar to fixed income than it is to anything else, because you have, in the fixed income world, you have fragmented liquidity, right? You have all these different broker dealers, one guy has a 90 bid for a bond, the other guy's offering it at 88, and, it's all over the place. same as crypto, right? You have this fragmented liquidity across all these different exchanges and OTC desks. So, a price in one exchange is different than a price in another. You also have, unlike stocks where, every company's stock looks essentially the same and it's the only real nuance is whether or not they're paying a dividend or not. In the fixed income world, you have different coupons and different maturities and different covenants and different call structures and, essentially in infinite permutations of different types of fixed income assets that you can have. You have different issuer types from governments to corporates. You have, obviously every sector, like, everything in fixed income. You wouldn't have the U.S. government doesn't issue stock, right? But the U.S. government does issue bonds. Again, it was just, you look at the crypto landscape and it's the same thing. We have different issuer types from decentralized protocols to, governments and individuals to companies. You have totally different tokenomic structures. You might have an inflationary token. You might have an amortizing token. It might be 20% issued at launch. It might be 100% issued at launch. You might have, all these different mechanisms of buybacks and burns and different things to look at. Like it's 100% similar to fixed income. And we spent a lot of time just writing about this. And I think I started my blog, which is, I think in middle of 2018, I wrote the first blog on the Arca website. We've been doing this every Monday now for 7 years. And it's amazing, in my opinion. Like I mentioned, the white space that we were solving for that others weren't doing. I was like, oh, this white space will exist for 2 or 3 years and eventually it'll close. If anything, the white space is getting bigger. There's more fast money traders who don't know anything about the underlying assets. And there's more venture investors who are thinking about this purely from a technology lens. And there's nobody looking at this stuff from a pure fundamental research standpoint. I shouldn't say nobody. There's a very small group of funds and individuals who look at this stuff from a pure valuation standpoint. And it's baffling to me because we've been writing and talking about this for 7 years, talking about the nuances and the differences of all these different token types and the sectors and the issuers and all that. We put out our first taxonomy 4 or 5 years ago. I just saw that AI16, you're getting caught up in AI. A16Z just put out a taxonomy, just yesterday, kind of trying to differentiate the nuances of different token types and issuers and stuff. But it's like, this stuff was obvious to us 7 years ago, and it's still not that obvious, I think, to the majority of people in crypto. They still lump together, people still lump together like Bitcoin and Ripple and Fartcoin and Aave, even though they are completely different tokens from completely different issuer types with completely different tokenomics. So it's interesting. It's interesting to watch that evolution from that kind of day one tight Regis office to where we are today.
So yeah, when you guys first launched, the focus was on fundamentals, and it sounds like it's still exactly the same. But what are the metrics you guys are tracking in the early days comparative to today? Is it like, because a lot of people argue like there are no fundamentals in crypto, and then some people say, oh, of course there are, and it's still up in the air. I don't think it's the decided thing, but I'd love to hear your take. Like, hey, no, the metrics that we're looking at are transactions and it's cash flow and blah blah blah. It's like these are real things that we can track and measure and make valuations from.
You said you're not sure if it's decided yet. It's 100% decided. There are fundamentals in crypto. The people who don't know if there are or not are the people who haven't spent the time to actually do the work on it. If you were an equity investor back in the early 1900s, before Graham and Dodd wrote their first valuation framework book, you thought that there was no such thing as market cap. You just looked at price and didn't even understand what market cap was or price to earnings, right? It was just, you were trading the tape. Go back and read books like Reminiscence of a Stock Operator, where they're talking about, the late 1800s, early 1900s, where traders were literally just trading based on price and had no idea what the underlying actual stock was. It didn't mean that they didn't have fundamentals. It meant the people trading it didn't understand what the fundamentals were. That's a very big difference, right? Not having fundamentals is different than people not understanding what they are. Same thing with fixed income. The Frank Fabozzi Fixed Income Bible, that came out in 1960, that explained things like, duration and convexity and all these different things that are now, commonplace in the fixed income world. That wasn't known, prior to that. And prior to the LBO boom and Salomon Brothers and all the ways the debt market boomed in the 1980s. These things definitely have fundamental valuations. Just because we don't agree upon them yet doesn't mean that they don't exist, right? Like if you gave 10 equity analysts the exact same inputs from a 10K or a 10Q, they're largely going to give you the same output because everybody uses the exact same technique now to figure out a DCF analysis, discounted cash flow or present value analysis on stocks. If you gave 10 fixed income investors the exact same inputs, they're going to give you largely the same outputs because, again, it's an agreed upon methodology for how you value fixed income. You gave 10 crypto people the same inputs, you're going to get wildly different outputs right now. And that doesn't mean that there are no fundamentals. That just means that the book hasn't been written yet that everybody adheres to. There's no standardized ways to do it. And in some ways that creates massive alpha. In other ways, it can be incredibly frustrating because you're sitting on something that is way more valuable than it's trading at. But if nobody else agrees to that valuation mechanism, it's not going to trade to that level. So when we think about value, it's really quite simple. Value has to come in one of three forms. It either has to be financial value, which is traditional revenues, cash flows, right? Something that, a DeFi protocol, for example, take Radium or Aerodrome or Hyperliquid. These are businesses that are pretty simple businesses, right? People go there, they trade, the protocol takes a fee, and that fee, may or may not be distributed back to token holders. Radium and Jupiter, for example, and Hyperliquid do buybacks. Aerodrome doesn't. Aerodrome has the VE model. Again, lots of nuance here. This is not just, Fartcoin versus Ripple. There's actually real things to look at here. But that's financial revenue. That's financial cash flows, right? You can model the DeFi space, for example, using traditional financial valuation techniques. The second type of value is utility value, right? Is it useful? Can you use it for something? Can you use it to pay gas? Can you use it for collateral? Can you use it for staking, right? Is there something you can do with it? And when you look at a utility model, it's very different than a financial model, right? A financial model is DCF based on cash flows. A utility model is basically about demand and supply sinks, right? Like, for instance, how much ETH is sitting in MetaMask wallets doing nothing, just waiting to be used to pay gas? That's a demand sink, that's a supply sink, right? Some percentage of Ethereum is basically going to be uncirculating forever because it's sitting in wallets to be paid for gas, right? Same with Solana. What percentage of ETH or staked ETH is used for collateral, right? You basically remove that from the circulating supply in a model based on utility, right? And, like, for example, aluminum has a lot of utility, but not a lot of financial value, right? Aluminum is very useful, but it's not worth a lot. So you have to really figure out, like, well, how useful is this? Again, this goes beyond crypto, right? Like airline miles, Starbucks points, right? Those are things that are useful. You can use them in some way. So that's the second form of value. The third form of value is social value, right? A cool factor. Is this something that people want to be a part of the community? Do people want to talk about it? Is there mind share, right? You look at companies like Kaido and that measure the mind share. Is there a cool factor to it? And social value is incredibly hard to value. I have no idea how to do it still. We've been looking at this stuff forever. But you can't deny that there is value, right? You can read any behavioral psychology book and learn about, why things catch on, why things go viral, right? You can't say that Hawk Tuah, which was 100% social, didn't have value. I mean, she created a lot of value for, 3 short months before she, ultimately is heading to jail. But, that's social value, right? There is a real value to it. So when we look at valuing digital assets, we're looking for things that have 1, 2, or 3 of those forms of value. We tend to never invest in something that only has social value because, again, we can't invest in that. We don't know how to value it. But things that have some combination of financial and utility value and social value are really interesting investments. So again, I'll just use the protocols that I think people are familiar with. Like Solana is a good example of having all 3, right? It has real financial value with the MEV. As a result, there's real cash flows that go back to the Solana network. You can go on Token Terminal or Artemis or anywhere and see the amount of revenue that protocol creates, every day and every week. It has real utility value, as we mentioned, right? You have to use SOL in order to pay for gas. You have to use SOL as a trading pair. You have to use SOL for, collateral and staking and things like that. And it clearly has social value, right? There is a real tribal community around SOL. So 100%, there's fundamental value to the Solana token. Now, again, if you gave 10 people all the inputs I just mentioned and told them to come up with a price target for SOL, you're going to get wildly different outcomes right now, right? I'm sure Multicoin would say it's worth, $10 billion per soul. Someone else might say it's worth $5 per soul. But that doesn't mean that it doesn't have fundamental value. That just means that we don't all agree yet on how to value it.
Do you think that we will come to a consensus anytime in the next few years, let's call it 5 years, as a industry that, hey, these factors are what matter, and this is how we should value this? And as mentioned before, you'll give it to 10 crypto analysts, and they'll come out with, hey, this is roughly the value of Sol, and everyone kind of agrees.
I can't even get people at this point to understand the difference between a cryptocurrency and an asset-backed token. The idea that we're going to have anybody agree on valuations in the next decade is I mean, there's people out there still being like, I would never invest in cryptocurrencies. I'm like, what does that even mean? They're not even they're so different from each other. That's as stupid of a statement as saying I would never invest in ETFs. You'd be like, well, what does that mean? What kind of ETFs? They're all different. The ETF is just a wrapper that holds currencies and commodities and equities and debt. They're like, oh yeah, sorry. You can invest in ETFs. I meant I wouldn't invest in these types of ETFs. Okay, that's a logical argument. Well, that's how you have to treat crypto as well. You can't say I would never invest in crypto. Like, they're all different. Bitcoin has nothing to do with Dogecoin, which has nothing to do with Ripple, that has nothing to do with a DeFi DEX, that has nothing to do with a company like BNB or Binance who owns these are 100% different issuers, different token types, different value accruals. To say that you would never invest in it is just such a stupid and outdated, it's as dumb as people who still call everything that's not Bitcoin an altcoin. Like, again, there is so much misinformation out there and so much just purposeful misdirection in this space that we are a long way away from agreeing on valuation techniques. We can't even agree on what to call this space. Again, like I don't even think a crypto investor will exist in 10 years because, you're going to be a healthcare investor and you're going to trade your healthcare bonds, your healthcare stocks, and your healthcare crypto. Like, there's not going to be a crypto asset class. It is just a wrapper. You can put anything inside of a digital asset. You can put a meme coin issued from Trump. You could put Disney token where, Disney gives 10% revenue kickbacks to the token holders, and the token holders can use the token to, get fast pass at the parks and to, pay for your Disney Plus subscriptions and to maybe get early access to some new IP and movies and things like that. Like, you're going to have New York City token where, how do you bet on the growth of a city right now? There's only one way. You buy real estate. Like, that's insane. Not everybody wants to buy real estate 3,000 miles away. But what if New York City token was, replaced revenue bonds and general obligation bonds, and they start issuing New York City token to fund development, and that token gives you discounts on the subway and the buses, and it gives you, faster access to the airport at JFK and LaGuardia, and it gives you a lottery system to, have your kid's birthday party in Central Park, and if New York City runs a surplus, they dividend it back to the people owning the token. Like, again, this is a wrapper. It is a part of the capital structure now that any company, individual, university, city, can issue a token as part of their capital structure, and you can put any sort of tokenomics and design into it that you want. So, that hasn't happened for the last 3 years because the SEC has had their foot on the neck of the industry, and as a result, we've ended up with this, awful version of crypto that's just meme coins and silliness. But like, it is 100% going to happen. You are going to see a world where, all these different entities have tokens at some point, and they're all going to be completely different, and you have to look at them all differently. So no, I don't think we're anywhere close to having an agreed upon valuation technique.
What role do tokenomics play in fundamentals? For example, if we had a coin some token that had incredible financial value because they were generating tons of revenue, buying back the token, buying and burning, let's say. So from a financial value perspective, it looks very good, but the tokenomics maybe are totally messed up. So how do you view tokenomics within this framework?
Yeah, I mean, you just said it. You can have good company, bad token. You can have bad company, good token. It's no different than the bond world, right? You might have the best company in the world and the worst bond because there's no covenants and no restricted payment clauses, and that even though this company has only $1 billion of debt, that they're going to have 10 billion of debt one day, and it's all going to be, ahead of you in seniority. So you can have good company, bad bond. You can have terrible company, great bond, right? Maybe you have the best bond in the world because it's a secured bond backed by the assets of the company. And the fact that the company is failing is actually a good thing because now you're going to take over the assets as a bondholder. The same thing is true in crypto. You can have great project, horrible token. You can have horrible project, great token. Token design is probably more important than anything. And again, it's why I get so frustrated when I hear someone just say altcoin, or someone say, there's no fundamentals, or crypto as a whole is uninvestable. It's like, they're all different. Let's look at Binance, for example. So Binance had the benefit of not being in the US, right? So they were able to do something that was logical and made sense, versus everyone in the US who has to, come up with these convoluted tokens to avoid securities laws. So Binance became the fastest growing company, I think, in history, right? Now has a $100 billion token market cap, or $80 billion token market cap. Probably has somewhere in the $100 to $300 billion equity market cap, given the money that this entity prints. So what did they do? They issued a token, the BNB token. That BNB token was 100% issued at launch, right? There's no inflation. It wasn't, one of these projects that puts 10% of the token out there and then inflates at 50% a year to try to incentivize people to do it. No, they issued 100% of the token on day one. They gave roughly 20% of profits back to token holders through a buyback. They allowed you to use the BNB token as trading pairs on their platform, to get discounts on trading fees, to use it as collateral for options and futures trading. They even had partnerships at one point with like travel companies throughout Asia. You can see where I'm going with this, right? There was real financial value through the revenues and profits of the business and the buybacks. There was real utility value in the way that you could utilize that token across their platform and beyond. And it had real social value in that, like, people wanted to be a part of the Binance growth and the Binance community. So what happened is Binance became the fastest growing company in history because they incentivized all of their customers by being quasi shareholders of the business, right? So did the equity holders get mad that 20% of the profits were being used to pay token holders? No, because it created a better equity market cap for them, because it created the stickiest, most loyal customers in the world who were all BNB token holders. So ultimately what you're doing is you're aligning the growth of a business with the most important person in your business, which is your customers. And the design of that token, combined with the way that they incentivized and use their customers as part of their growth story, should be studied in Harvard business case studies. I mean, that was the best token design and the most impactful token ever created. And yet nobody's doing it that way because, again, they lump BNB in with a Ripple, a Fartcoin, and all this other stuff, right? Like, that should be the number one thing that every exchange, every investment bank, every OTC desk, every person in crypto should say, look what Binance did. It is the biggest, most profitable company in crypto, and it's almost 100% due to the fact that they had a BNB token that helped incentivize their customers to stay on the platform and become lifelong customers and evangelists and quasi-equity holders. And now you look at the difference between that and something like McDonald's, okay? If you had a Venn diagram of McDonald's shareholders and McDonald's customers, would it even overlap? Do you think any McDonald's shareholders actually shop at McDonald's? And do you think any McDonald's customers own the stock? There's zero coordination between their shareholders and their customers. None. The customers could not care less about the growth of McDonald's, and the shareholders could not care less about the customers and the food of McDonald's, right? You could go further. Like, if you're a Delta Sky Miles, frequent flyer, do you really care about the growth of Delta and its stock? No, you don't care. You're there for yourself and your points, right? If you're a Delta shareholder, do you really care about the customer experience? No, like, you don't care. You're just like, there's all these different examples of companies and projects and entities where there's just complete misalignment between the customer and the shareholder and the employees. And tokens solve a lot of that. And we should be seeing more and more of that. And again, it comes down to token design. Like, you look at that Argentina token and the fraud that happened with that Libra token that was recently. Like, do you know how there's so many different ways that could have gone with better token design and better people running it? Again, like, I get frustrated because I'm a capital markets guy. I was an investment banker. I was a debt and equities capital markets guy. Like, I'm here, like, call me. I'll tell you exactly how to do it. Like, there are investment bankers who dedicate their lives to thinking through how to structure something, and nobody uses them in crypto. They just, some 24-year-old kid creates a project. They get some 26-year-old venture investor who tells them what to do with their token, and they get some 28-year-old fraudster who convinces them how to issue it. It's like, this is not that hard. There's some basic tenets of capital markets in terms of how to design a token and how to launch it that ensure more success than the way that most projects are doing it. So I think to me, it's again, it's very obvious where we're headed. It's just not obvious how long it's going to take to get there.
It's probably better for you and I the longer it stays inefficient, because if it's very efficient, that means most of the alpha is gone probably. But anyways, if you had to choose one token design that you think fundamentally provides the most value to token holders, would it be buybacks, or what is like the optimal, like everyone should have this design in their token because it's the best?
I think it's hard to say in a blanket way because different companies are different. Like, I mentioned a Binance or like a Bitfinex or even like a DEX, like a Hyperliquid or a Jupiter or Radium or Aerodrome. Like, those are businesses that can essentially be profitable on day one. So it's much easier for them to create revenues and use those for buyback. So I think if you have a business or a project that can create revenues on day one, then yes, you should essentially issue all of the token on day one, do nothing with regard to incentives, and ultimately use the revenues and the cash flows of the business to start amortizing the token through buybacks. Bitfinex has that token, the Leo token. It's the best performing token in history. It goes straight up and never goes down, because they issued all of the tokens on day one, and they use revenues of the business to buy back tokens every day on chain. You can see it on their, there's a Leo Burn website where you can see exactly what they're doing. Plus there was like a kicker in the token that said if they ever recovered the money from the hack from 2019, that they would use that to buy back the token, right? So like, that's a great model for a revenue cash flow producing business that can do that. But, you look at something like DePIN, for example, and by definition, DePIN can't do that, right? Decentralized physical infinite, like take a, like a Helium or a Hive mapper or something like that. By definition, what DePIN is doing is they're saying we need to build the supply side of our network first by incentivizing people to build out the network. And then if we're successful many, many, many years later, then maybe we'll take the revenues and the cash flows of the business to actually buy back that token. So that's a different structure, right? That's a much longer tail game where you kind of have to accept the fact that the token is going to go lower before it goes higher, right? Because, again, you're giving away the token to incentivize somebody to do something, but there's no demand for the token until you actually build out what you're set out to build. You were incentivizing people to build bowling alleys. So you just started, giving out free money to anyone who built a bowling alley. Well, that's great. You're giving out this free money, but like, it's going to take years before these bowling alleys are actually built and start creating revenue and cash flows to eventually pay back the people that, you gave the money to, right? So it's like, you just can't come up with one token design that works for everyone. You have to really think about, what the actual goal of the project is. And that's why I think a lot of these, I mentioned Disney already, like a Disney, a Netflix, a Barstool Sports. I mean, these are kind of, entities that could easily issue a token in their capital structure. And you could have a token and stock in your capital structure, just like Binance does, and it works fine. Anything that has a subscription type business, like a Reddit or a social network, a Twitter or a Facebook or an Instagram or a Reddit, like they could easily have a token, right? And that token can be, a quasi equity hold, where you're getting some kickback from the revenues and cash flows of the business, but you can also use that token for, certain attributes on the website and things like that. But again, that's very different than like a layer one smart contract protocol that has to be inflationary because it has to actually pay, the validators, whether it's, proof of work or proof of stake or whatever, like, so I think this is again where if you're thinking about launching a token or building a project, like there should be investment bankers in this space that are helping you design these tokens and thinking these things through. And I think a lot of that stuff is completely ignored in this space. It's just how fast can I get a token out there and see if it pumps. It's like, that's not the model, right? The model should be, what are you trying to accomplish? What do you need to do with your business? And how do you design a token that helps you accomplish those goals? And I think if we did that, we'd have much, much, much better assets in this industry. And again, you probably have a lot more differentiation. Like you shouldn't have a month like February where basically everything was down the same amount. Like that doesn't make sense. Even in the equity market right now, while the NASDAQ was, fell 10%, there's other value stocks and, other defense sectors that are up. Like, why are the DEXs, for example, why are the tokens of the decentralized exchanges down the same amount as meme coins when trading volumes are at all-time high? and the percentage of volumes being traded on decentralized exchanges relative to centralized exchanges is at all-time highs. I mean, you can go on the block dashboard and look at that chart. I mean, it looks like this. I mean, the amount of volume that's happening on decentralized exchanges is growing exponentially relative to centralized exchanges. And most of these are doing buybacks of their own token. So like, to me, that would be a defensive sector, right? If volumes are skyrocketing and liquidations on futures are skyrocketing while the market is going lower, where do you hide out? You want to hide out in something like that, but it doesn't happen right now because there isn't a sophisticated investor base yet that does that kind of rotational trading the same way that happens in the debt or the equity market.
What are your thoughts on DAOs and governance? Because I've seen you guys in the past be, quasi-activist investors. I don't know if, it's exactly activist, but it's, the most activists out there. How do you guys feel about DAOs and governance? Because, some people say it's not really effective. Some people say they're great. What are your general thoughts there?
So we have been, historically, we've done a few, I like to call it constructivist campaigns, not activist campaigns. I think the word activist tends to have a negative connotation, whereas constructivist is more trying to force change. Like, for example, what's happening with Ethereum right now, and everyone being upset with the Ethereum Foundation. And what happened? You start getting loud enough, you start, making enough noise, and what happens is you start to make changes within the Ethereum Foundation, and you have a competitor like Ethereal come up. Like, constructivism is good. To force change is a good thing. If there's a reason why change needs to be forced. So we've done a few of these things. I mean, I think the most famous one was when we did it with Gnosis 5 years ago, when, the Gnosis token was trading at, 5 times the value, or sorry, the Gnosis token was trading at the cash on their balance sheet raised from the Gnosis token launch was sitting at 5 times the value of the Gnosis token. So it was like, wait a minute, like, why are we funding your business to sit there on cash and not do anything for the token? So we fought them for a year to essentially tie their token to the assets on the balance sheet. And it was a huge win for us. It was a huge win for token holders. And I think it was a good process of, influencing and forcing action through social pressure that ultimately then would have to go through a vote in the DAO. I think the issue that I have with most DAOs is it's very hard in the early stages of a company to have a democracy. Like, there's a reason, in the early stages of the company, you need a single decision maker, and that decision maker needs to be the king and needs to be, her way or the highway, right or wrong, at least there's decisions being made. You can't really, again, we started Arca in 2018. Like, imagine if every decision we did in the very beginning of our business was like up to a vote of 50 people. It was like, we would get nothing done. We wouldn't even have an office. Like, we wouldn't even be able to agree on what office to work at. Whereas, instead, our CEO said, this is the office we're working on, show up tomorrow. Okay, fine. Like, was it the best decision? Probably not. It was an 1.5-hour drive for me, but it was a decision. At least we could move forward. So I think most DAOs probably could work over time when the business is big enough and sort of more mature enough, but there needs to be a lot of changes with it. Like, there should be a cadence. It should be every month you come to the, essentially the board of directors meeting. I mean, think about what a DAO is, right? You're essentially the board of directors, right? You have people who work at the company. That's your CEO or your C-suite, your executives. And then the DAO holders, the token holders, are essentially the board of directors. Okay, well, it wouldn't work to have a board of directors when it's just random things to vote on when nobody's paying attention in the middle of the night. Like, how about having a cadence? The third Tuesday of every month, there's going to be a DAO vote. And if you have something to bring to that table, submit a proposal by the second Tuesday of every month, and that will be voted on, right? So if there was a little bit more structure within the DAOs of, here are the rules of things that absolutely have to go through a vote in the DAO versus things that don't have to go through the DAO and the executives can just make decisions unilaterally. Okay, that would be helpful, right? Okay, so, if I'm investing in this project through the DAO governance token, well, I know that, what you're paying employees is not up to me. That's up to, the founding team. And they can do that unilaterally without having to ask me, or like what office they work out of. That's unilateral, they can do it. But if we're going to make a design change to the token, that's going to have to go through the DAO. And, every month or every 2 months, we show up to this DAO, meeting and be like, all right, is there anything to vote on today? No, there's no proposals. Okay, great job, carry on. Oh, actually, this time there was a proposal. The proposal was, we want to institute a 10% buyback of the token. Great. You had plenty of time to prepare for the vote. It went through, yes or no, and you move on. So DAOs can be done better, certainly. And I think a lot of it just comes from communication. I mean, you look at how hard it is right now to get even basic information about some of these crypto projects. the supply of their token, the tokenomics, the white, did the white paper change, things like that. Like some of the stuff is just simple, basic IR. There's a reason that companies spend a lot of money on their investor relations departments because it matters talking to your investors. Like if you're going to issue a token, you better think that through. If you're going to have publicly traded tokens and you're going to have a huge investor base of your tokens, then you have to start thinking about how you communicate with them, whether you're a DAO or not. Like there has to be some thought put into that.
Yeah, it's funny because I wanted to ask you about alpha decay in crypto, but everything we're talking about, you're like, no, it is so inefficient. We can't even come up with like normal standards at all. So in your opinion, do you just think crypto is going to be the most alpha rich market over the next, 20, 30, 40 years maybe?
I'd like to think that, but then at the same time, I noticed today that the best performing portfolio year to date would have been owning Cardano, Bitcoin Cash, Ripple, Litecoin, Monero, and Tron. Yeah. So, basically it means if you went into a coma in 2018 and woke up on December 31st, 2024 with a bunch of cash ready to deploy, you'd have the best portfolio in crypto right now.
Okay.
So, I'd like to think there's alpha, but then again, I'm not sure what causes some of that alpha. I think the real answer is we have spent the last 7 years proving that the technology works, right? We know the protocols work. Very few of them have had massive downtime. That, a lot of them have learned from previous mistakes and figured out how to build functioning smart contract protocols that work. We have DeFi applications that work. While every bank and brokerage still goes down all the time, that's not happening on the DEXs. That's not happening on the lend borrow platforms. Aave is like the 60th biggest bank by deposits at this point, and has had no downtime in 24/7. So like, we know that this technology works, but the assets available to transact on this technology are largely garbage. You have equity-like tokens that are not very well thought through, right? In a lot of cases, you have memes, you have, massively inflationary tokens, et cetera. Like, I think that's the next leg of crypto is you have to have better assets on these platforms. But if you think of what a blockchain is essentially just a way to move assets. Well, 99.6% of the world's assets are not on chain right now, right? Your stocks aren't on chain, your bonds aren't on chain, your real estate isn't on chain. Come on, like ultimately, the best way to think about it is if you go back to like the early 2000s and the dot-com boom, right? There was a reason things were called dot-coms because these were internet native businesses that would not have existed if not for the internet. And therefore we slapped a .com on the end of it to describe that this was an internet native business. Well, how many .coms are there today? You wouldn't even call them that because everybody's a .com, right? Every single business that has existed for hundreds of years is now a .com. Domino's Pizza is a .com. JP Morgan is a .com. Walmart is a .com. The .com fell off because it was no longer just internet native companies building on the internet. It was everybody using the internet. Well, that's kind of where we are, I think, in the inflection point of crypto is that the early crypto assets were cryptos, right? These are all businesses that would not have existed if not for blockchain, right? But pretty soon, everyone's going to have a token. Like I said, New York City's going to have a token. JP Morgan's going to have a token. Disney's going to have a token. Trump has a token. Like there's not going to be this crypto native investment world. It's going to be everything is traded on blockchain rails. And that's ultimately where a few areas of crypto will really succeed, just like a few .coms succeeded, and most will die. But the overall industry will be a better place. So, where I have our money is, I think a few protocols will end up being the winners. And we don't necessarily know who those are yet. I mean, even though Ethereum and Solana have a massive lead over everyone else, again, the actual assets that are being traded on those platforms are kind of garbage assets, right? You don't have, imagine if the US government came out tomorrow and said, we're going to put everything on chain, but it's all going to be on the Sonic network or something, right? Like, okay, well, the Sonic network all of a sudden is going to be bigger than Ethereum and Solana simply because they have the best customer, right? So we don't know who the winner is, but it appears that Ethereum and Solana have a pretty big lead right now in everyone else in terms of the smart contract platforms. Then the DeFi applications on those platforms are obviously going to be major winners when more and more things come on chain. I mean, you're already seeing it in terms of the growth of these businesses in terms of asset base and volumes and things like that. So when you can start trading stocks and bonds and home equity on chain, It's going to obviously be a huge beneficiary to your hyperliquids, your Jupiters, your Radiums, your Aerodromes, your Uniswaps, et cetera, your Aves. And then I think a few other sectors will probably be beneficiaries as well because they help make the on-chain experience better, right? Whether that's oracles or AI agents, that help you navigate on-chain, or it's, a few, mostly stuff like that, right? It'll mostly be the protocols, the DeFi, the AI, and then, you'll have a few random winners. Like, again, if you're making the .com analogy, a few random .coms succeeded, a few random .cryptos will succeed, right? Maybe it's, Grass protocol or Helium or something in DePIN or something like that, right? So there will be a few random ones here and there, but, I think it's pretty clear cut that the majority of the assets today are garbage, awful assets, but the technology is probably the most impactful thing to hit capital markets and finance. And we just have to get past this regulatory workflow issue, where we start bringing the good assets on chain. In fact, you could argue that we've gone the wrong way the last 2 years, right? What have we done? We've brought good technology onto bad rails through the ETF. Like, why are we putting Bitcoin in an ETF? Why are we putting Ethereum in like, why is Litecoin going into an ETF? Like, we don't need a terrible asset like Litecoin going into a terrible antiquated rails like an ETF. Like, we need to go the other way. We need to put NVIDIA stock on chain. So, that to me, it's a little bit binary right now, in the sense that investors know where we're headed and they know that this is going to be the most impactful technology. But there's just not that much usage yet because the assets aren't great.
So the guiding principle on the liquid side of the portfolio is really around fundamentals. On the venture side of the portfolio, is there a guiding principle? Because, as you're talking, like, so much more needs to be built out in order for us to really hit, actual mainstream. Do you guys have a specific area of focus on the venture, like DeFi or, whatever, or is it just really a little bit of everything?
Yeah, I mean, from a compliance standpoint, I have to be careful talking about specific funds, but we have different types of funds at Arca, right? We have liquid broad-based mandates. We have more niche-focused mandates focused on specific sectors. So it depends on which fund you're talking about, but we do have a venture fund that's more broad in mandate where, we want to give investors just exposure to all the areas of growth in blockchain. So that's going to be, that's going to be pretty chain agnostic across different chains, across different sectors, et cetera. And then we have other more niche focuses that are just like, we believe 100% in just this sector or just this area of crypto. And we want to, give investors who also share that vision, specific exposure to just that. So it depends. But I think in general, again, we're big believers in DeFi. We're big believers in NFTs, not profile pictures, but ultimately NFTs like medical records and things like that. We're a big believer in gaming. The idea of one day LeBron James, you owning the character LeBron James from NBA 2K and being able to port him over to Madden and play tight end for the Lions. Things like that, actually being able to own assets via NFTs through gaming is something that we believe a lot in. We certainly believe in the intersection of AI and crypto. I think this is probably the most no-brainer application of crypto right now, in the sense that, LLMs like ChatGPT have sort of opened the eyes of the consumer of what an LLM can do, but it's very restrictive to what you ask it. Whereas like a crypto LLM is much more like a jailbroken LLM where you can give it a personality or a social media account. It can actually make transactions for you and trade and invest for you and do things that, you're not going to see an AI agent walk into a bank or a brokerage account and get an account because they don't have a social security number, but they can easily have a wallet and transact on chain. So if you really believe that the future of AI is through actual agents doing things, those agents are going to have an economy, and that economy has to be on chain. It's just not going to work any other way. So, the intersection of AI and crypto is something that we focus on. But this stuff evolves. I mean, we talked a lot about in early 2018, none of this stuff existed. We didn't know about stable coins and DeFi and, Web3 and DePIN and AI and gaming. So, our theses certainly evolve as the market evolves. But currently, that's where I think the biggest opportunities are.
Which subsector within the world of Web3 are you extremely bullish on, but it's just too early? Like, for example, for me, it's digital art. I'm extremely bullish on digital art as a personal as personally, not from a fun standpoint, but just personally, someone that likes to collect art and wants to, be involved in art. I just see it as a way more efficient means to collect art and just like kind of achieve status, because art's a great way. It's kind of a great status game. But I also know, like, man, it's going to take us to have like augmented reality glasses for that to really take off in a major way where it overtakes the physical art market. Is there something like that? Is there some subsector that you believe kind of has similar, you're extremely excited about, but you just know it's way too early?
I mean, I think gaming is definitely fits that bill. I think people often just underestimate how long it takes to really build a good game and how much money it takes to fund it. This is not unique to crypto. I mean, anybody who invested in anything, any sort of gaming in the traditional world or any sort of movie studios know that it's a big kind of, most fail and a few succeed, but the ones that succeed have to go through 7 or 8 rounds of funding and a lot of iterations before you get there. But I do think, again, the idea of introducing NFTs and AI agents into gaming is one of the most obvious natural things. I mean, I have young children, 8 and 12 years old, and they watch people play video games all day long on YouTube. Pretty soon they're going to be watching AI agents playing games that are, essentially owning NFTs and skins within the game and ultimately selling them on marketplaces. Like, that's an obvious one that's just going to take some more time. Further with NFTs, like you're mentioning with like art, I do think, there's just so many industries that can be disrupted through this. I mean, think about just how broken the healthcare industry is, where, let's say I go to, Cedars, because I'm just getting a physical, and, Cedars has a big workup on what kind of, patient Jeff Dorman is, 45-year-old male, healthy, etc. And then 3 weeks later, I have some medical emergency with my heart and I have to go to UCLA for an emergency. And they have a completely different profile of who I am. And, there's no coordination between the two systems. It's like I'm 2 different people. Whereas like eventually medical records are going to be NFTs. You're going to own your own medical records, be able to release them to doctors and as you need. I mean, things like that they're obvious, but they take time. Where like, there's no doubt that blockchain would massively, massively improve global healthcare. But that might not even happen in my life for all I know.
How do you think about building Arca, the firm? Because you guys have a pretty large team now. I don't know the exact number of folks, but when you're looking to hire, specifically on the investment team, what traits or what backgrounds are you looking for?
So we've gone back and forth on this. We have a pretty good mix of, seasoned kind of financial professionals, as well as, kids right out of college with no experience. I'd say we've probably had more success with people with no experience than we have with people with a lot of experience, simply because, this is a volatile business where, 1 year you're making a ton of money and the next year you're making nothing. So in order to kind of ride out those highs and lows, you need people who actually are passionate and believe in the industry more so than just sort of mercenaries looking to clip a paycheck. So like 2020 and 21, for example, we actually hired a lot of Wall Street people who were like really excited about crypto and came over. Not one of them still works at Arca. They all left because they didn't actually care about crypto. They had no interest in it. They were just there for a paycheck. And when the downturn happened in 22, they're like, nope, I'm done. I don't care. Whereas, we've had some people who, live and breathe on chain. I mean, they don't even own a brokerage account. And like, their entire world is on chain. And they have historically been better fits at Arca because of the passion that they have. So, I think we'll look at anyone. I mean, anybody who, if somebody emails me and says, I want to work at Arca, the first thing I say is show me your wallets. Because if you don't have active wallets, then why would I am not here to teach you how to use a wallet. Like, go figure that out on your own. I mean, this is the easiest industry to get involved in on your own. Show me what you've done. Show me your on-chain activity. Show me what protocols you've used. So I don't really care what you know. I care that you are interested in this space and actually utilize it. Like, if you tell me all you own is Bitcoin on Coinbase, you're not going to succeed in this industry. But if you tell me that you took your Bitcoin and you bridged it to Ethereum and ultimately borrowed on Aave and then bridged it to Solana and played a game, like, cool. And it shows me at least care and are interested.
So the service providers within crypto, I mean, this is going back to 2018. It was a rough going for at least us, like working with even lawyers to set up entities, and fund administrators was a total nightmare. Things have gotten a lot better. But today, if you had to choose one specific pain point on the kind of operational fund side, whether it be like compliance or whether it be the compliance providers, specifically the fund administrators, the tax, the audit, or wallet management, what is that major pain point that you have operating your firm?
Yeah, it's a great question because, I mentioned in the early parts of Arca in 2018, like we spent a lot of time doing due diligence on the service providers. Like, the debt and equity world, you hear the joke like two guys in a Bloomberg, because that's literally what it takes to start a fund. You just two guys, a Bloomberg, you pick whatever prime broker and you want because they're all the same. Once a year, they'll take you to dinner and try to woo you to another one and tell you why they're so different, but they're not, they're the same. Whereas in crypto, it's very different, right? Even the best companies in crypto have only been doing it for 7 or 8 years at most. They're all brand new. You have to do a ton of due diligence on who you're working with and why. And then, like you said, a lot of it has improved. And this is, again, why I just think the 2022 analogies based on price action are just so dumb. Like in 2022, like everything broke. Like right now, custody works. Trading largely works. Lending largely works. Auditors are back. Like every fund in crypto lost their bank and their auditors in 22 and 23. Like, that's not the problem anymore. So, I think everybody across the industry has gotten a lot better. I think there's still on the liquid side, we have more problems than on the venture side. I think most of this industry is still built for, venture kind of private more so than it's built for like liquid on chain. The amount of kind of hoops you have to run through when you're passing an audit and when you're going through fund administrators to show proof of assets and things like that are still a little bit desirable. But I'd say the biggest pain point is that there's still no prime brokerage. The capital inefficiency of this space is really damaging. And part of it is just by design with what crypto is, right? Crypto is a T+0 settlement asset. So because it's T+0, you have to have assets everywhere that you trade. Whereas when you do a T+1 or T+2, you don't have to have your assets anywhere and you settle later through a prime broker. So the fact that nobody has really solved that yet, that like, if I have, assets that I want to utilize in some way, I have to physically send those assets somewhere to use them, right? Either to sell them through an OTC desk or to use them as collateral on a futures exchange. There's nobody yet who has amassed a big enough balance sheet where you can just say, you can see our wallets, what we have in terms of assets. Let us pledge those assets as collateral, even if we don't give them to you. You charge us a small fee, a prime brokerage like fee, to let us do whatever we want, but we're never going to physically move our assets. And that doesn't exist yet. So that makes things incredibly difficult still. Like you are still moving assets around way too much to do things in order to, if you have assets in one place and all of a sudden there's a new token launched somewhere else, you have to physically move the assets over there and get it. Or, you want to sell something, but it's in custody. So it takes 24 hours to get it out of custody before you could sell it because nobody can sell it if you don't have it. So I think it's going to take some time and to really figure out prime brokers. There was a few attempts of companies that pretended they were prime brokers and would throw prime brokerage on their website. But the reality is they weren't actually doing that function. The function of a prime broker is to allow you to trade first, settle second. And that doesn't exist yet.
All right, 10 years from now, where's Arca going to be?
Honestly, most likely we get bought, just because, the TradFi world they're going to buy, they're not going to build. It's just easier to buy a company that already has track record and already has operational excellence than it is to build in-house. So the honest answer is any company that still exists in this space in 10 years is probably going to get assumed by someone else, would be my guess. But, look, the goal of any company is to diversify your revenue streams. So, one of the things that we've tried to do at Arca is, we started as an asset manager, just running, hedge fund-like strategies. Then we've diversified the actual fund offerings that we have, like we said, to have different types of funds for different type of investors. Then we also have a labs division where we're actually building on blockchain rails and trying to design product offerings. So ultimately, like any company in finance, you ultimately are just trying to diversify. You don't want to be a single product focus. You want to have different hooks into different areas of the ecosystem that ultimately have completely different drivers of success or failure in the business.
Hypothetically, who would be a acquirer of a firm like Arca? Because it's, I guess I don't often hear like hedge funds and venture firms being acquired. Obviously, there's certain instances, but it's not as common as like a custody business or something like that. So would it be like I don't know, like a Tiger or like a BlackRock? Like who would be like, just hypothetically, who would be the acquirer?
Well, I mean, again, it depends on which side of our business grows the fastest, right? If the lab side of the business and product offerings grow the fastest, then you might have, a service provider, somebody who wants that product offering. If our advisory business grows the fastest, where we're actually helping with token launches and token structuring, maybe it's an investment bank that buys you. If the asset management arm grows the fastest, it might be a large asset manager. So it sort of depends on, like this is very Arca specific, but in general, I think all of those types of companies I mentioned will be acquirers at some point. I think you will have brokerages and investment banks ultimately buying crypto companies. I think you will have asset managers ultimately acquiring, teams and assets that have expertise. I think you'll have massive service providers acquiring. So I think you are probably 12 to 36 months away from a massive M&A boom in crypto, because this is probably the biggest disconnect we've ever seen in terms of crypto people being miserable and, down big on their prices, while everybody outside of crypto has never been more bullish, because all they're seeing is, the positive headlines of, the White House Crypto Council and the SDC, dropping lawsuits, and the FDIC saying banks can get involved, and BlackRock talking about tokenization, and Robinhood talking about tokenization, and Goldman and Morgan Stanley and Bank of America talking about, getting involved, and State Street and Boney getting, it's like, the non-crypto world has never been more bullish. The crypto world is, hiding with their head in the sands, crying every day about the price action. So, you're going to see some consolidation and some M&A, largely because a lot of these non-crypto native firms are going to try to build and realize how hard it is and how cheap it is to acquire entities that already exist.
All right. So yeah. So I guess building off that, do you expect to see a big rush of crypto specific IPOs over the next, call it 2-3 years?
I think they're going to try. Again, they tried in 21 as well, and then the market turned and they weren't able to do it. But the same companies that you've been hearing about for 4 years are still trying to figure out a way to go public. So I think you'll see a little bit of that. I think where it'll get interesting is eventually a company that actually has a token will go public, and that will be really interesting, because again, this world that I see where every company has both stock and a token on their capital structure, someone is going to do that in a public fashion, right? There's going to be some entity that goes public that also has a token, and then people are going to have to figure that out. And no different than the hedge funds today go long the bonds, short the stock, or long secured bonds, short the unsecured, long the stock. Like you'll pretty much eventually see people go, I'm going to go short the stock, but long the token. It'll just be part of the capital structure. And I think it'll be really interesting when you see, in 5 or 10 years, that'll just be normal. Every company will have stocks, bonds, and tokens on their balance sheet.
In a world where there's many publicly traded crypto companies and tokens, which asset type are you most excited about? We'll call it next 2, 3, 4 years. So let's pretend there's a lot of IPOs in crypto companies. Are you mostly bullish on the equity or the tokens?
Well, I think it depends. I mean, look, the reality is there's only 3 types of companies that have made any real money in crypto so far. It's been lawyers, right? I mean, lawyers are cleaning house. I mean, look at how much the FTX bankruptcy extracted from the industry. So lawyers are killing it in crypto. Service providers are killing it, right? Any sort of exchange, look at Bybit getting hacked for $1.5 billion. They're like, no big deal. We'll just take it out of our petty cash. The exchanges are killing it. Just wallet providers, things like that, right? Those are the ones who are making all the money. And then token issuers, right? People who have actually issued a token. I mean, Ripple, look at Ripple, for example. I mean, Ripple has made hundreds of billions of dollars just by selling a token and not even having a real business behind it. So, ultimately that's who's going to go public first. It's going to be a service provider, or some sort of a token issuer that goes public. You're not going to see one of the smaller kind of unique niche type industries going public. You're not going to see an asset manager go public anytime soon. So I think you have to recognize that the early kind of crypto publicly traded companies are all going to look exactly the same. They're all going to be fee extractors. And then over time, you might see, other unique businesses that are able to go public. And then, then it'll be interesting, right? It depends on the token side. So, again, I mentioned the fixed income world. Like when you look at cross capital investing, when you look at capital structure investing, it's not always like, oh, we're always going to be long the bond and short the stock, or always going to be long the stock and short. It depends on the covenants of the bond. And the same thing will be true in the token world, right? If you have some token that is effectively levered equity, right? Maybe 30% of the top line revenue of the company goes to the token holders. And also there's, a massive supply sink because of the way the token is used. You might want to go short the equity, long the tokens, because, essentially you have the same downside risk, but much higher upside in the levered equity or the levered token. It might be you have a token that is just so poorly constructed that you're like, this company is going to kill it, but that token is going to zero anyway. So it really is going to be a matter of digging into what the design of that token is and how it creates value to decide how that capital structure play will work.
Very cool. All right, Jeff, this has been incredible. It's time for the quick fire closing questions. All right, you could go back in time before you started your firm and give yourself one piece of advice. What would that be?
I think if you're looking to start a firm, the best piece of advice is make sure that you can be selfish for 3 to 5 years, because it is all consuming. It is impossible to have a real life outside of your business when you're in build mode. And if you can't do it, make sure you're partnering with someone who can. For instance, I have a wife and 2 kids, but my partner does not. So, he's able to be a little more 24/7 on the business than I can be at times. So I think that's probably the most important thing. And then I would also say, like, really delineate and differentiate the roles when you start a company, because everybody can't wear every hat forever. Eventually, you really have to figure out, what different people's strengths are, and how you guys sort of fit in a giant puzzle.
That's great. All right, what's the most unexpected lesson that you've learned throughout your entrepreneurial journey?
Listen more, talk less. It's especially hard as a hedge fund manager because, people pay to hear my thoughts, but for the most part, and as a result, you get trained to talk. I mean, we've been doing this for an hour and a half. I've been talking nonstop, right? You get trained to talk, you get trained to present your ideas, but the sign of a good business is to have people who work with you who have really good ideas as well. And you don't want to dominate too much the conversation. You definitely want to hear what they have to say rather than tell them what you think.
That's great. All right. What is a piece of content, book, blog, podcast, et cetera, that had a really big impact on you?
I forget who wrote it, but it was a book called To Sell is Human. And Daniel Pink, another behavioral psychologist, Daniel Pink, To Sell is Human. It's basically a book about how everything in life is sales. A teacher is effectively a salesperson trying to convince the students to listen to them. A doctor is a salesperson trying to get the patient to listen to them. Everything you do in life is sales, right? So it's not enough to have the idea. It's not enough to be smart. You have to figure out how to get people to listen to your ideas. And that's a really impactful part of anybody in any stage of life or career, is to learn how to not just do what you want to do, but to get people to believe in what you're doing.
I love that. Wow. All right. Last one. How do you define success? And do you think that you've achieved success?
That answer has changed over time. I'm very money driven. I always have been. I hate businesses that don't have a scoreboard. I've sort of that surgeon mentality where, like, I need to know right away if I won or not. So that would certainly be the number one success driver for me for most of my life. Although as I've matured and grown and have a family, I would say it's not actually the money that is the success. It's the time, right? The money creates the ability to have the time, whether that means better access to healthcare or, the ability to go to your son's baseball practice. So I think it's all ultimately, there's actually a great movie. I forget the name of it because it was really, actually, I take it back. It's a terrible movie, but it's an interesting movie. I think it was Justin Timberlake and I don't remember. The whole premise of the movie was that there was no such thing as money. It was just time, and you have to basically like build up time credits. And when you run out of time, you die.
So good.
Yeah. So I think time is the ultimate. The goal is how do you get as much time as you can.
Amazing. Yeah. No, that movie was terrible, but it was such a cool concept that it somehow resonated with so many people. So
it was Olivia Wilde. It was Justin Timberlake and Olivia Wilde. I apologize to everyone listening right now who actually goes and watches the movie because it's a terrible movie, but it's a great film.
Amazing. Jeff, thank you so much. I appreciate this. This has been incredible. where can people find more about yourself and learn more about Arca?
Yeah, I mean, if you want to hear our thoughts in the markets, go to our website, ar.ca/blog. You see all the educational content and research and everything that we write. If you want just me specifically, you can find me on Twitter at jdorman81.
Thank you, Jeff. Appreciate it.
Great. Thank you, Andrew.